Thank you for attending. And we're going to start off with looking at silver and precious metals as well within that. So my esteemed panel, I've got Ned Leyland from Jupiter, Ronan O'Connell from StoneX, Bradford Cook from Endeavour Silver, and Ian Williams from Charteris Treasury Managers, all very bullish on silver, I'm sure, but we're going to hear about why and some of the dynamics. So Ronan was going to start us off with some slides to sort of frame what we're going to be discussing here and talk about the market a little bit.
Thank you. Good morning, everyone. Thank you for coming. Lovely to see you all here. I'm not going to give you a full-scale presentation because that's not what this is all about, but just to set the scene. The four pictures here, as you can see, look at the basic fundamentals of supply and demand. So I've broken out mine production by region, and by source. These numbers are taken from the most recent Silver Institute survey, the numbers for which are put together by the admirable team at Metals Focus, many of whom are my former colleagues. A lot of us used to be at GFMS. And so there's no point in me reinventing the wheel. So I've taken these numbers and put them up for demonstration for you. Probably the most important thing to point out here, I'm sure everybody here knows this, but the vast majority of silver supply is price inelastic, in that it comes out of the ground either as a byproduct of copper, lead, zinc, gold, as you can see, and only 23% of the world's primary silver production last year, or mine production, I should say, came from primary silver mines. And when you add the industrial scrap component into that, that brings the overall supply down from primary silver down from 23 down to something like 18% of total, with the rest of it coming out regardless of price. And one can say something similar about palladium. We're not going to go there today, but those are the two predominant metals within the major metal suite that do not necessarily have a market clearing cost of production. And on the demand side, the fabrication here is on the bottom left. The demand includes net physical investment. I actually think that it's probably more valid when you see the headline saying silver in a deficit. Well, yes, it is. But if you strip out investment demand, which can be very variable, then industrial demand does not actually meet the overall levels of supply. And it looks as if over the course of 2022, we could be throwing off something like 3 months worth of global industrial demand in terms of excess supply. But it does look, if the investment sector continues on its merry way, where it has been over the past couple of years at least, as if all that metal will be absorbed into private hands, either in the commercial sector or amongst investors as a whole. And here we have it broken down, and you can see what's been happening. I've split it by country and then by year rather than the other way around. Germany and the United States, you can see how very strong they've been over the last 2-3 years. India has obviously had its problems with respect to lockdown. Canada and China have been broadly steady, and elsewhere we're still seeing an increasing trend. This is partly as a function of silver as gold's younger sister, if you like, particularly in the States. And the reason for that is that there's a long history to it. It goes back to the days of the gold standard. When the dollar was on the gold standard, it was illegal for private individuals to hold gold as an investment product, so they turned to silver. And of course, there's a thriving North American silver mining industry as well, which helps to generate further interest. As far as the exchange-traded products are concerned, this is tonnage and the contained value just purely on the basis of the daily silver price. And we can see that there's been some erosion. It's actually starting to turn around a little bit, as is the managed money position on COMEX. Been under a little bit of a cloud over the last 5-6 weeks or so, but starting to show some improvement. Overall investor sentiment generally is friendly, both to gold and to silver. On an underlying basis, you wouldn't think so over the last 5-6 weeks or so. It's predominantly been dollar-driven. Yet again, all eyes are on the Federal Reserve, and the next meeting for that is in the middle of June. And that is one of the economic projection meetings. There are 8 Fed meetings every year, 4 of which, March, June, October, and December, are the meetings in which we have the famous dot plot, where the members of the Open Market Committee estimate where they think the Fed funds target rate will be at the end of this year, next year, and then further out. Markets watch that like a hawk, no pun intended, and almost invariably you'll find that there will be some movement in the price in response to what the FOMC says. And silver tends to work with gold, as I'm sure all of you are aware. Generally speaking, when gold's in a bull market, silver will outperform. When it's in a bear market, silver underperforms. And it's been a little bit in doldrums over the last few months or so because it's been in the kind of frame of mind where it's tended to take the worst of all worlds. Gold's not been doing very much, and silver you would expect to drift, but it's also been casting a look at the industrial side of the market. And as I showed you in the previous slide, it is predominantly an industrial metal. It has the precious cachet because it used to be a currency, and it has the jewelry and the investment component. But when you look at those in the round, between the two of them, jewelry plus investment comprise about 35% of overall silver offtake in any 1 year. And compare that with gold, it's the other way around. So gold is between 65 and 70% in those individual components. So if I'm asked to forecast the silver price, then I'm not alone in this. I think most analysts go the same way. We tend to look at gold and then apply a ratio. And that gives us what we expect for the price, because as I said at the top, there isn't really a market clearing price in terms of costs of production. And there's the relationship. You can see that the ratio topped out in 2000. It's been rising recently. It's just starting to contract again a little bit, which is what you would expect in a bull market overall. So having set the scene, I will leave it at that and hand over to you, Adam.
Yep. Thanks very much, Rona. Well, let's get into it. What, Ned, can I start with you? Why buy silver? Or what's appealing for silver for investors now, both sort of retail investor, but also the institutional investor as well? And why silver perhaps over gold?
Well, morning, everyone. I can see that silver's that popular that we're packed out. I think give you a little indication as to the overall sentiment. A room like a certain point, we'll all be like sort of Harry Styles, and it'll be absolutely packed out. You won't be able to move in here. The basic answer is attribution, Adam. So it's the reason to invest in silver is its potential optionality and its potential attribution versus owning physical gold. I will say though that listening to Rona talk through some of those slides, it is sometimes a challenge to explain to people the price discovery mechanism in silver and the fact that really it is still real rates. It's that driver. It's the cash market driver. The fact that silver trades in foreign exchange markets alongside gold makes it a monetary metal versus a precious metal, and it's the attribution potential that certainly when I'm talking to people that they like. Because in modern portfolio management terms, leaving retail aside from a minute, I mean, retail generally, certainly deep retail, they want to blow their brains out in 10 minutes, crypto, anything that has, huge swings is what they're interested in. But for the institutional investor, the problem with the asset class, the monetary metals asset class, is that it doesn't really offer sufficient attribution overall portfolio level with just pure gold. And you'll find they will do that. So they'll have 2, 3, 4, 5% in a physical gold exchange traded product. And it simply doesn't have a meaningful impact at overall portfolio level. So, I mean, the pitch is you buy silver for attribution. As you can see from the ratio and the relative performance between the two hasn't worked that well for a long time. But the truth is that's just because people haven't been doing it. It's everything is capital flow sensitive. It doesn't matter what asset class we're talking about. And we have had, pretty much no, overall flow towards us, with the exception of very short periods. But yes, it's the attribution pitch, the beta, the fact that silver potentially can squeeze, as we saw with that little 2-day silver squeeze narrative a year and a bit ago. That would be the answer. Yeah.
With respect to your point on capital flows, do you see things changing in this environment? Is the macro picture that we're talking about now going to kick capital back into silver as well as gold?
Well, yes, but for me, when I think about the technicals of silver, nowadays I don't really almost pay no attention to it. So the answer is absolutely, but it will take gold going through that 40-year high. So adjusted for the CPI, gold still hasn't made its way through the high of 1980. So we're still stuck below this ceiling. And for that reason, the whole thing has no narrative and it has no flow. So, I was discussing this with Ian next door. We're having a coffee, and ultimately we've got to get through this key level. When we get through $2,100 in gold, then everyone's a buyer, everyone's a momentum chaser, and people will love silver and money will pour in. But until then, we're waiting for this moment where the real interest rate expectations become, drop off a cliff, which they've been trying to do, but the Fed's been very clever about pretending inflation's not there and then pretending that lots of rate hikes are coming. So they sort of switched within that real interest rate conversation. They were pushing back on there's no inflation, and then okay, there's lots of inflation, but we're going to do lots of rate hikes. So they've been keeping gold down through real interest rate expectation management. And when that shifts and gold goes through 2,100, the whole damn thing will happen. And then we have Harry Styles, and we have to stop people come in here and everything.
Yeah. And is that around the corner? Is it really close? Crystal ball? No.
I'm sure the others will have a view on this one.
Yeah, let's bring everyone in. Ian, what's your take on some of this?
Yeah, hello. Right, morning, everyone. Yeah, I sort of semi-agree. The key to me in all this is the massive trillions and trillions of dollars tied up in the bond market, which is now unequivocally in a massive bear market. And at some point, the penny has to drop, that investors have to get out of this asset class of a monetary asset and get their money into real assets, because either the Fed is going to put rates up, do a Volcker style and bring down inflation, or they're going to chicken out and not do it. And I think when the penny drops, we're in the latter camp. I think Ned is as well, that they're actually going to chicken out of putting rates up, because there's so much debt around in the system now than there was when Volcker was put rates up the last cycle. When it becomes apparent that they're not going to put rates up, then they're going to they're going to let inflation rip. They haven't got, when push comes to shove, they haven't got the determination to do what's required to bring down inflation. And when investors see that, and they're sitting in bonds yielding, in the case of the gilt market, 2%, or treasury bonds 3%, and inflation is 9s, and then maybe it comes down to 4 or 5, but they're still massively negative. You're still in a long-term bear market for bonds, and you've got half of global portfolios tied up in this asset class, which is losing money in a monetary asset when inflation's rampant, and you ought to be in real assets, not monetary assets. And at some stage, you only need a fraction of the trillions of dollars that are tied up in the bond market to start switching into gold and gold mining and silver mining companies. The liquidity isn't there in the silver miners and the gold miners. So it's easy enough to take some money out of the bond market. It's not quite so easy to put it to work in this sector. So the liquidity is a complete liquidity mismatch. And when that happens, when the penny drops, it doesn't have to be all investors, just some investors take some of their money out of bond markets and put it into real assets. This sector will take off. But when's that? Nobody knows. But there'll come a time when the penny drops and people start doing it. Exactly what happened in the 1970s.
Yeah. And do you think we're in this sort of recessionary territory now that's going to lead to that flight into real assets?
Well, the US GDP was already negative in the last quarter. It's not going to take too much for it to be negative again. So you get 2 consecutive quarters of negative GDP growth. Are the Fed really going to start raising rates when the economy's in recession? So again, it backs up our thesis that they're going to chicken out putting rates up, which means they're not serious about fighting inflation.
Brad, could I get your commentary on this and some of the market dynamics?
Yeah, so maybe a little more color from the market. I'm the president of the Silver Institute this year, and we launched our 2021 review and 2022 forecast about 2-3 weeks ago. There's basically 2021 was obviously a great COVID rebound year. Supply was up 5%, demand up 19%. Every demand metric was up sharply. I think the biggest was actually investment demand, 36%. Electronics was 5%, photovoltaics 13-ish. So it was a good bounce back year. And it created, according to the Metals Focus, a deficit last year of 52 million ounces. And we did have a bounce in the silver price, but it's obviously under the weather now. The forecast for this year is continuing with 5% supply growth and about 9% demand growth, and growing the deficit to 72 million ounces a year. So against that backdrop, why isn't silver doing better? Well, there's basically two, countervailing pressures in the silver market right now. In terms of both short and long-term demand growth, industrial is very solid. I mean, it'll obviously slow down in a recession, but if you believe any of the 10-year studies for EV growth or solar photovoltaic growth, we have to find another 200 million ounces in the next 10 years just for two industrial applications. And that's not going to be easy. And of course, on the monetary side, if you include investment demand, jewelry and silverware as one class, basically stores of value, that's half the total demand. And so now you've got this battle between the Fed and other central bankers raising rates, which is generally not good for gold and silver. And that's the current theme. And then when that theme changes, then the whole investment thesis, as Ian said, will shift towards real assets. And so I think in our sector, we're just waiting for that shift to happen. And then you've got two currents driving silver forward, the industrial and monetary.
Yeah. Just on the industrial side of it, then, could we hone in on that a little bit more? Because it's an area where a lot of silver miners would sort of be able to sell what they do. How significant is that playing into the future application of silver? Are you seeing that going to be increasing a lot more over the next decade? The EV projections and everything you mentioned are very much there. But if that's not going to kick the silver market on, are people going to be looking for sort of substitutions, etc.?
A cycle of inflation and higher interest rates will slow that growth down. So it's a tug of war on the industrial demand side. But when the monetary thesis takes hold, it trumps all.
Yeah, just to chime in on this, the silver squeeze moment, I don't know if any of you spotted this last year. I would just make the point that I think there was a 10-day period where the largest silver investment product purported to add something of the order of 150 million ounces, which is completely not going to happen. So I would make the point that while the industrial side is very important, and Brad's making this point, that's a slow chugging, physical demand-led phenomenon, whereas investment demand can just turn around from nowhere, and particularly in a world where everything's about trend following, and markets have become more and more and more and more like this. Literally, oh, this is the hot thing. I need to do this for the following 3 reasons someone told me on Twitter, or whatever it is. What really matters here is at what point do people say, oh, I should have 1%, 2%, 3% of my portfolio in silver. And we saw that narrative just bed in for a few weeks, whatever it was, 18 months ago now. And silver didn't quite get through that key technical level of $30, which really is very important. We get through there, I think you'll see yet more of the same. And there was some interesting stuff happened. That quantum being required in one investment product is, oh dear time for the just-in-time silver market. The big difference with gold and silver is gold's available. There's plenty of gold. Gold is everywhere, but that's not true of silver. So investment demand turns up in size. And of course, this is core to the thesis the whole way through. We've all been waiting for it. So I will say I would have been saying the same thing to you for the last 20 years. But there is no doubt that the way that people invest now and the way they trend follow and the way that these products are all available to them on their phones, etc., leads to a much more real likelihood of this happening now than has been the case previously.
Ian, you want?
Okay, yeah. The other factor that everyone, I think, is in sort of broad agreement that at some stage we're going to see a sharp upward move in the price of silver. And I think if you look at commodity markets and metal markets in general, they tend to trade in rotation. So you've already seen it in nickel. Nickel went from $20,000 a ton to $100,000 a ton in like 2 days on a short squeeze. Because nickel, the stocks at the LME were getting quite depressed and people started to pick up that there was a shortage. And don't be surprised if something similar happens to silver and copper, which are probably the prime two new industry metals, some stage over the next few years. Now, against that slightly is that this COVID situation in China, where they virtually locked down the entire Chinese economy and manufacturing, because this is where most of the electric cars are going to be made over the next 10 years, may have pushed this date back somewhat. Hasn't stopped the likelihood of it happening, but it may have pushed the date back, because you probably need for the shortages to appear in the silver market, you probably need to see the Chinese economy fully open again. And there's, something like, is it 300 or 3,000 car makers in China all churning out electric cars. That's where the physical demand is probably going to come from. But until the Chinese economy opens up, it's probably a bit of a manana trade.
Yeah, China's a net silver exporter at the moment, as you know. It's, at some point, that pivot will be key, because you'll start to see there'll be a drain on supplies as opposed to a surfeit. Certainly, as far as photovoltaics are concerned, the growth rate from from the United States Department of Energy, I think it was, the growth rate in peak wattage from 2006 to 2019 works out at just under 11% per annum. And we've gone from 0.3 gigawatts to 16 gigawatts in 2021, and we've already had 5 gigawatts going in the first quarter of this year. That's just in the States. That's the real key, and also all the other different electrical components within the electric vehicle fleet, which, and certainly on the numbers that I've been looking at, primarily from a PGM perspective, it has to be said, the latest projections that I've been able to nail down, and they're very long term, so there's obviously going to be changes, but it's around about the year 2038 where we reach the point where internal combustion engines are being scrapped more quickly than they're coming out, because obviously 2035 is the final year in which any ICE cars or light vehicles can come off the production line. So it's the next 10 years really where the industry is gearing up for that position, that silver demand is going to be, it's not necessarily exponentially rising, because there's always thrifting in everything, but there's already been a lot of thrifting in photovoltaics, and the cost per watt back in 2006 was $4.31. It's now 41 cents.
Very good. Okay, look, let's move on to talking about the miners then. Mining companies, silver mining companies. Not as many out there in terms of compared to the gold miners. How do you look at the sector at the moment? How is it performing? How do you invest in it? What do you like, Ned?
Well, present company being borne in mind. So look, silver miners are, or what we would consider to be primary silver miners, are as you mentioned, not that broader church, and generally, they have to be considered to be a higher risk, hopefully higher reward, but higher risk proposition than a gold miner, because basically operating margins are lower. Now, part of that, in my view, is due to the fact that I think silver's been mined for a pretty uneconomic price for a very long time. So as a result, we're in a very, very tight sort of geological condition. But the answer to your question of how we think about it is the same as I think anybody would think about running any portfolio, which is in a sort of on a section view. You have different slots to populate. So you've got your larger producers, you've got some mid caps, you've got development assets, and you've got, I suppose, pure exploration as well. At the moment, I actually sort of prefer development assets because they're not having to operate, which in this market is probably a good thing. Now that tends to make them, just as sensitive or more so potentially than other parts of the portfolio. But, you've got to try and mitigate the operating risk. So whether that's geographical, supply chain, quality management, you need to be on top of the individual forms of operating risk that you're exposed to in silver mining space, and more so, again, even than would be the case in gold, due to the fact that your operating margin is very, very skinny at these prices, therefore making them that much more sensitive. But in a way, the fact that there aren't so many to look at tends to mean that you can have a relatively good level of knowledge about your narrow peer group, so long as you're meeting management lots and running quality models and this, that, and the other.
Okay, excellent. Ian, how do you look at the silver miners?
Well, it's a very interesting space because at the moment they're under the cosh a bit from rising energy prices, and their costs are going up and the metal's not going up, so potentially the fundamentals aren't looking as good. But as my other guests have pointed out, on a sort of slightly longer term view, the demand for silver from the green decarbonisation agenda and electric cars and solar panels and all these other things is going to rise. Now, the more the silver miners are not in a particularly great space at the moment, just means that in future the supply of silver onto the market is potentially restricted, which means that when the price spike does come, it's going to be all the greater. And when the price spike comes, and no one knows when that is, but I think it's coming, when it does come, the silver miners will tend to outperform the gold miners by quite a long way.
Let's hope so.
Yeah.
Let's hope so.
Brad, what's your view though, as a miner? How is the environment now operating?
Well, I came to that sector 18 years ago as an exploration geologist, and I think that's one of the ways you can differentiate Endeavour Silver from the rest of the silver group is that we do still live and die by the drill bit. We try and grow our mine lives every year through the drill bit. We make new discoveries like Terranera to build new mines. And most of the rest of the group, when they look to grow, they don't look to grow through the drill bit. They look to buy something. So, and it's really hard to buy something in silver, dominantly silver. There's a multitude of gold dominant deposits worldwide of all different sizes. But silver dominant deposits are really hard to find. So we've been, I think, very particular in what we're willing to do. We've pretty much stuck to our knitting in terms of high grade underground vein type mines. And yes, we, like others, have fought the cost curve in recent years. But we're I think at near the bottom of the trading range for silver right now, and we're making money. So in terms of picking mining companies in the silver space, there's really only two that are dominantly silver. I think it's First Majestic and ourselves, and the rest of them are materially less than 50% revenue from silver.
Yep. There we go. Okay. If anyone has any questions for the panel, by the way, please raise a hand. Anything at all. We'll bring a mic round. Okay, I wanted to come back to the central banks for a second and just talk about what might be different. There's a lot of parallels drawn with the 70s you mentioned, and just talk about the balance sheet situation of central banks now being quite different from then, and how you interpret that. And central banks primarily buy a lot of gold. How is that impacting the this environment that we're in right now, and how it might be different actually from some of the 70s parallels that we talked about? Yeah, Ian.
Okay, well, in the 70s, you didn't have quantitative easing for a start. You had the likes of Ted Heath printing money like confetti, but it wasn't really done as a quantitative easing. So what you got, and the Bank of England, the Fed, the worst case of it at the moment is a Japanese central bank that is intervening in the bond market, stopping 10-year yields going above 0.25%, and will just print any amount of yen just to stop that happening. So the biggest example of money printing at the moment is in Japan. The Fed, which claims to be tough on inflation, is still printing money, even though they, if they were serious, they would have stopped it months ago. They're supposed to be moving to quantitative tightening, but we shall see. The Bank of England by now, everyone who sort of commentates on the Bank of England, they made a massive strategic mistake in 2020 by doing another 150 billion of QE when it wasn't necessary. So they've all been printing money, and as a result, we have these high rates of inflation that you see around the world today. In terms of other central banks, other than the Western central banks, they're probably all going to be buying gold. And for two reasons. A, as an inflation hedge, because the Western central banks and the Japanese aren't particularly serious about cutting inflation. But the other big factor that people should be aware, and this affects gold, not necessarily silver, is the freezing of the assets of the Russian central bank. China at the moment has $1 trillion in US Treasury bonds. At some stage, it might have a move on Taiwan. The fact that the Americans seized the assets of the Russian central bank because of Ukraine, China's going to look at this and think, well, before we make a move on Taiwan, we've got to get our $1 trillion out of dollars and out of treasury bonds. So what are they going to switch into? They can't switch into euros because that could be frozen. They can't switch into pounds because that might be frozen. So gold is really the only alternative that they can switch in terms of liquidity. The Russians did. It took them about 4 or 5 years to switch all their they had about 600 million of treasuries. They switched that into gold. China's going to have to do the same before it makes a move in Taiwan. Otherwise, its reserves potentially get frozen. So you're looking just from China, potentially switching $1 trillion of treasury bonds into gold bullion and also shipping the gold back to China. There's no point leaving it in the Bank of England where it can be frozen. So. And other central bank, if I was a governor of a central bank and I had my money in treasury bonds and dollars, I think, well, if I fell out with the Americans, my assets could be confiscated or frozen. So and this is long-term stuff, 4 or 5 year view. All non-Western central banks are potentially India, anybody, Latin America, Africa, Middle East. Everybody is going to potentially question how safe is it to have your money in dollars and US Treasury bonds. This is the price the Americans pay for weaponizing the dollar, I'm afraid.
And one of the interesting things I find about the official sector over the last couple of years or so is that with the recent exceptions of Turkey and India, virtually all the major purchases have come from the Eastern European states. And I think we can probably all understand why. The other comment I would make about that is that the Chinese are notorious for not releasing what they're doing with their gold holdings. Mind you, no central bank does. But the point I'm making here is that the Chinese come up with sporadic, large-scale changes in holdings. In other words, they report a big change. Whereas, in fact, almost certainly what they've been doing in the background is they take in domestic mine production and they'll take in other metal. They don't necessarily report it. To use a London Metal Exchange analogy, they white line it. They'll have it in one part of a bonded warehouse and then they'll ship it across the line and, hey presto, it shows up in the reserves. And we haven't seen any recorded increase in Chinese central bank holdings 2.5 years now, something like that. I wouldn't be at all surprised if we do get a big quantum leap at some point. I don't have hard evidence of it, but I wouldn't be at all surprised on the basis of decades of experience in this industry if they're not actually still quietly accumulating it, just not telling us.
Yep. Ned, do you have a view on central bank balance sheets and extra physical purchasing coming through and how that's changing things?
Well, I do. I mean, I think that my view will tend towards the more kind of long cycle, radical version. Look, I think that what happened is the world called the bluff of the petrodollar ruse at the end of the 70s, and the Americans managed to get the system back in balance by taking rates so high that that your real return holding dollars and holding cash was sufficiently good that gold was pushed back into this 40-year bear market, effectively, that I referred to earlier. And I just think we're revisiting that moment right now. So what's happening is the commodity producers and the rest of the central banking community knew that this petrodollar system wasn't going to work forever. And when you talk about central bank balance sheets, I think it's a bit of an irrelevance because central banks are the state. They're the state. That's just the way you need to think about it. That's the state, and they only care about one thing, which is control. They want more of it, that's all, and they're going to get more of it. Now, the fact that they blow themselves up in terms of their fiat balance sheet in the meantime is not really the point. What happens afterwards is what matters. And they've told you they're going to give you, fully tracked and traced central bank digital currency system afterwards, which will give them more control than they've got now. So I think that, we're about to relive that moment in 7980 when everyone goes, no, we're not doing this anymore. And, exactly where central bank balance sheets go, I don't know. But the gold that they all own is the sterilizing factor within the overall monetary complex. So if you think about it like the original, hopefully some of you are old enough to remember this, the original Ghostbusters movie. At the end of the movie, they're all standing there and they're told, don't cross your plasma guns, that'll be dangerous. So of course they do that, and it sucks all the ghosts into this box on the road. And then the film ends. And, that's what gold does at the end of the cycle. Effectively, its role is to suck all of the obligations back into the box, and then you reset. But, when you think about central banks, think about what they've got planned next, rather than just thinking of it on a linear basis. What's the number? It's about where's the cycle? What are we going to get next?
Yeah, and that is the digital currencies thing that you touched on was going to be my next point. How fast is that coming, and how real an impact is that to gold and silver as well? It seems that crypto was initially a great additional asset class for private money, but now the central banks are sort of flipping it into their own tool, and we've seen the crypto market crash obviously recently. So it's sort of less appealing for sort of the individual, I suppose, in some respects.
The latest comment from the Fed was last week, 10 days or so ago, and it was very much, we're thinking about, talking about, looking at it. So they're aware that it's there, but they're really not terribly interested at the moment.
No, but China's moving ahead with their own version. That's an interesting dynamic as well. Obviously easier to apply given their command economy.
And the Fed, as Ian's point is well made about the Fed dragging its feet with respect to inflation as well, and real interest rates, because the Fed's balance sheet at just north of 8 trillion is twice what it was before the pandemic, and they're talking about not quantitative tightening necessarily, but balance sheet runoff, which basically means that when securities mature, they don't reinvest them. And if they do it at the rate that they've said they're going to do it, if they were to take the balance sheet back to where it was previously at around 4 trillion, which they won't, but if they did, that would take 7 years at the rate they're talking about.
Okay. Anyone want to comment on the digital currencies dynamic?
Yeah, I'll talk about it. I was one of the first people that owned Bitcoin in a long-only product. So we put it in the fund in 2017. But when the Swedish listed tracker launched on the basis it's digital gold, or was purporting to be that, so it's a subject I have reasonable knowledge about. I take Rona's point about they're saying they're thinking about it. I personally wouldn't take anything the central banks say at face value at all. I'd just burn it straight down. I think they know exactly what's coming. My view is that the whole crypto thing is simply training wheels for you lot. Is getting you ready for the new system. It's not what it looks like really at all. DeFi, which is the important part of this, decentralized finance applications, is the future. That's going to be a thing. They're not investments. They're services for the new monetary system, which you will be given. You'll be given a tracked, tagged, and traced government taxi, which will be your unit. And you'll be moving around in the decentralized finance world with your tracked and tagged state-sponsored vehicle. And it's all pretty Orwellian and pretty ugly. But they'll love it because the state, as I said, the state gets much more control. But I think that the issue here is the way that it's framed. That they're cryptocurrencies, which of course they aren't. And also that they're investments, which also really they're not either. This is a very important subject, and it's not going to go away. But I think it's the framing that's the problem here.
The technology service, as you say. Yeah,
that's absolutely right. There's a big difference between digital currency and crypto assets.
Yeah, indeed. And no store of value qualities there at all.
Look at the volatility.
In the long run, though, once the technology is sort of perfected and we're all moving into adopting that.
Well, So, I mean, look, people have different opinions on this, but I would say no, because demonstrably gold is the risk-free. But gold is the thing that measures everything. Go read the Roy Jastram book, Golden Constant. This is the reality of the situation. Gold is what measures goods and services. It's what measures everything. There's no store of value beyond what money is, and money is gold. Now, the fact that we use credit as money is, a confusion. People, you're not recognizing you're using credit as money rather than using money as money. And that goes back to Gresham's law and all of these things. But no, the only thing that's a store of value is the constant, and the constant is gold.
Brad, you look like you wanted to comment on the digital currencies element.
Well, I was just going to say that when you come through 12 years of free money and globalization of trade, and people are more than happy to put their money in many different places. But then that's an age of trust. And then when that trust is breached, so when you start backtracking and the 12-year everything bubble starts popping, then people withdraw to real assets. And real estate, certainly. Gold, absolutely. So I don't see any future for the current batch of cryptos. I think they're ephemeral. There's no store of value there, and they'll either merge or be gone in the next few years.
Yeah. Okay. And you talk about real assets, sort of wealth preservation mindset there, but it sounds to me like if silver's going to move, there's a lot of returns to be made here as well. So buy silver right now. Is this the case?
Yeah. Buy the dips.
Yeah, buy it and hold it and avoid the volatility.
Okay. Any questions from the floor? Yeah, we've got a question down here, please. Bring your microphone.
I've got a question for you, Brad. As president of the Silver Institute, how can you sit up there and just passively accept the role of price statement and make statements like, well, we're waiting for the market to change, when on a daily basis, the COMEX is manipulating the price of silver. And you as president have made no public role or statements to try to disclose this and to try to keep out.
Well, thank you for your question. The fact of the matter is that the paper market in silver is so many multiples larger than the paper market in any other metal that we don't have a choice. The paper market pricing pushes the physical pricing around, and that's just the way it is.
Exactly. The paper market is pushing it around. Why don't you highlight this and show the fraud?
Well, so you're going too far, because there's a balance between the specs and the commercials. There always has been. There was manipulation in the system, as you know, with Deutsche Bank and Scotia Makata and others. They're gone. They're no longer bullion bankers. And that was very short-term trading fraud. But in terms of conspiracy fraud, no, forget it.
Anyone else? Any other questions?
Well, I'd just like to add to that. When Ned was talking about the Reddit squeeze in February of last year, that was driven by people who knew absolutely nothing about the market. They saw that there was an outstanding large-scale outright short in the managed money positions and assumed that that was a short market, whereas in fact what it is, and it's not just the managed money, it's the commercials as well. When you see shorts on COMEX, the vast majority of those are actually the bullion banks hedging their long physical positions in London. So it wasn't an absolute short.
I'm gonna go the other way, as you would expect, and make the point that while that's true, that there is a larger observation. I agree with you that most of the people on Reddit didn't recognize this, but in fact, Brad himself said that the structure of the market is undoubtedly the case, that the banking system, the commercial banking system overall, is demonstrably very short silver. It's the very nature of it. So, in fact, they're right, the people on Reddit. They don't explain it correctly. One of the problems with this subject is it's quite full of very technical sort of, rabbit holes, and you've got to actually get the way you explain it right. But there is definitely a story there. And in fact, the important point is that, there isn't much silver around. And when people decide they want to own it and they go and buy for example, SLV, there is a huge issue. They don't have the silver. Indeed, they changed their prospectus in the middle of the night to take account for the fact there may not be any silver. So there is a story there. And the basic point about, making this more publicized is also true. But the best way that it can be resolved is by people taking physical delivery of silver. That's the simple point. And I'm sure we're all agreed on that. That's the way you do it, is you say to people, look, just find silver, stack it, take it away. And at a certain point, then the market will turn around and want more silver, and there is none.
Still, that's an almost insurmountable mountain because of the size of the paper market relative to physical. And by the way, there's a very simple reason why silver is the exception amongst all the commonly traded metals. It's the only metal that's a byproduct. I mean, 80%, well, almost 80%, including recycle, doesn't come from primary silver mines. And so the bullion bankers, when they enter into a contract to buy physical, they immediately go short. They clear their books every day. And so it's just, that's the why silver's different than gold.
Quick question. I'm a major shareholder of Alien Metals. It's got the richest silver mine in Australia, actually the nugget, 145 kilogram nuggets in the Perth Mint. And I suggest everyone go and visit the Perth Mint. I got a call from the Perth Mint saying, can you guys please produce some silver? This is the Mint. Can you please produce what? I said, what's wrong? He goes, we haven't got any silver, can't get silver. This is the Mint of the Australian government. I just want to try and understand if there is that shortage of the physical, and this is the Mint calling for it.
Yes,
how big is the paper market versus the physical? I just don't get it. Like, how do we or investors go, all right, let's take these banks to the cleaners. Let's expose this, short that they've got. What's it going to take? I know, I hear what Bradford's saying, but what's it going to take so that people actually hear this? Like, I can't sort of publicise and put it in a paper, but I got called by the Perth Mint looking for silver. That's the reality.
All the major mints around the world are currently on allocation where silver is concerned. They can't get enough.
Why isn't the price going up?
Well, largely because they can't get hold of the metals, so they can't meet demand. The spot price is not necessarily moving very much because it's such a deep market. But silver eagles were commanding $10 premium. So 3-4 weeks or so ago, that's where the price point is. It's in the premium, not in the spot.
The point here is that physical is what 3% of daily turnover. Okay, so you're right about this, and ultimately we need to get through $30 an ounce. Then everyone will be dragged in. They'll all want to do it, and then the cap blows off it. I got very close to it 18 months ago, but it's going to be gold that does it. It will be gold breaking out. That will drag everyone in, then it will happen. This is going to happen, but we've got gold. Gold drives the bus here, and the depth of the silver market, unfortunately, when the bias is not ramping, doesn't help. Unless we get to a situation where Samsung don't get any silver powder delivered to them for a quarter, and then they start panicking or whatever. But in the meantime, really, we're reliant on gold taking out that level, and then it will happen.
Okay, look, it's a fascinating discussion. We're right out of time. But of course, let's give a round of applause to our panelists. Thank you so much.